Hello traders, welcome back to my YouTube channel. So this video is going to be a continuation of the liquidity series that I started earlier. This is going to be the second part. All right, so today I will be talking about trendline liquidity. I'm going to show you guys how these trendline liquidity induces traders into taking a supposed good trades, and then after hitting their stop losses, it just moves in the other direction. And then after that, I'm going to show you how to trade these trend lines so that you avoid being the liquidity. All right, so if this sounds good to you, kindly stick to the end of the video, and if you're not subscribed to this channel, kindly hit that subscribe button, turn on post notification, and don't forget to like and share this video. All right, so let's hop onto the chart. Alright guys, so trendline liquidity. So what are they? How do they induce us to take the wrong trades, and how can we trade them the right way? Okay, so I am going to start with a pictorial drawing. Then after that, I'm going to show you real examples on the charts. Okay, alright, so before I continue, I just want to make this clear that I am not trying to sabotage anybody's strategy. Okay, I believe that every strategy works with the right knowledge and the right mindset. Okay, so this is just to make things clear for you guys, whether you trade chart patterns, smart money concept, or whatsoever. Every strategy works. Okay, so let's get this clear. Okay, great. So in the beginning of our forex journey, what we are taught mostly, especially when it comes to those who learn chart patterns, is that when we see something like this, we see an impulse, we see a correction, okay, and then the normal thing to do, or the right thing to do, is to take your buys on the third touch, okay, and then you're going to target your take profit, which has to do with the same length of the pole. Okay, so this pattern is normally known as a bullish flag. Okay, a bullish flag. Okay, so this is how we are normally taught at the beginning of our trading career. And then what we see is that price gives us a reaction on the third touch. Okay, not always, but most of the times we see price give us a reaction on the third touch. We are happy, we're in profit. And then what we see is that price smashes our stop losses, and then it moves in our direction, and we will be wondering what happened, why is this trade wrong, okay, or why did this trade take me out on the stop loss or even a break even. Okay, fine. Now if you have watched my first video on the liquidity series, you will understand whatever is going on here. Okay, so the reason why these trades fail is because of three things. Okay, we have three reasons why these trades fail. Okay, the first reason is because you are unable to read market structure the right way. The second reason is your inability to identify major liquidity pools in the market. And then the third reason is a reason which we all know, is that regardless of your strategy, I mean, you take a loss. Okay, no strategy is 100% right. Okay, so you definitely take a loss, which is inevitable in this business. Okay, so these are the three reasons: inability to read market structure the right way, inability to identify major liquidity pools in the market, and then an inevitable loss that you're going to take with regardless of whatever strategy that you are trading. Okay, so if you have watched my first video on the liquidity series, you see the price is making what? A low here, sorry, a high over here, a low, okay, and then a lower high and a lower low. Okay, so what I said is that this level over here is a protected what? Liquidity. Okay, so when price is coming from this direction, at least it should get to this level, which is a target liquidity. Okay, so you find out why this trade didn't play out. First of all, is because you were not reading market structure the right way. Secondly, is because you were standing in the way of liquidity. Okay, your inability to identify major liquidity pools, like I said. Okay, so why then am I teaching this? Because if losses are inevitable. Why again am I teaching this? The reason is because these can help you to avoid unnecessary losses that we take in the market, and then it can as well increase your win rate in the market. Okay, so real life example. Okay, we see the market make a high over here, a low, right, a lower high, and then a lower low. Okay, what do we see? Impulse, correction, okay, and then you're supposed to take it on the third touch. All right, and then what happens is that, let me just zoom in for you guys to see this. Okay, so we have our first touch, our second touch. Probably this is not a proper third touch. I don't mind. So we take this one over here as our third touch, and what do we see is that after the third touch, we see a very good bullish engulfing candle, whether inside bar engulfing candle, however you're going to call it. We're taught that when after seeing this bullish candle, it's just a signal to do what? Enter the trade, or to place your buy orders, and then you have your stop loss below structure. Okay, and what do we see? We take that trade, and then we'll be targeting somewhere up there. Okay, up there. But what happens is that this trade gives us a reaction. Okay, we get that reaction, and then it takes us out on the stop loss, and after that it moves in our direction. Okay, and trust me, seeing these things, it hurts. Okay, but at the end of this video, you will understand why you should avoid these kinds of trades. Okay, so like I said earlier in my first video, you're gonna see this place is a target liquidity. Okay, this price is coming from a protected liquidity point or liquidity zone over here, or a supply zone. Okay, so definitely at least price should get to this low over here, which is a target liquidity. So if you are taking your buys here on the third touch, you are making a mistake over here, because first of all, you are trading against market structure. Okay, market is making higher highs, like lower highs and lower lows. Okay, so first mistake that you did is that you are trading against market structure. Second is that you are unable to identify that this level over here is a major liquidity pool, which is a target liquidity. So definitely price is going to get here. Okay, so that's why your stop loss got hit. All right, so to the second example, again, what do we see? We see an impulsive move, and then a correction, probably refined. Okay, so first touch, second touch, and then a third touch to take the buys up. And what do we see? Again, zoom in again and show you guys. So when I zoom in, you're going to see the first touch, okay, the second touch, sorry with that one, and the third touch. Okay, so what do we see? We see that on the third touch we get that inside bar, that bullish inside bar over here, and that's going to be our confirmation for entry. Okay, so we set our buy stops with our stop losses below structure over here. Okay, and what do we see? We did not even get that reaction. Okay, we didn't even get that reaction. It just smashed our stop losses, and then after that it moves in our direction massively. Why is that so? Okay, so if you're trading smart money, you are going to understand that after this bullish break of structure, price needs to return to a level of demand in here. Okay, and that is what happened. Okay, so this buy opportunity that price presented, this fake buy opportunity that price presented, was just an inducement. Price needed to come to a particular candle within this zone. Okay, within this zone of which I teach properly. Okay, I'm not going to be revealing everything over here. So price need to come to that level of which it did. Then you can capitalize on that buy move to the upside. So if you're trading smart money, you have the right knowledge, you understand what is really going on here, you might have caught this trade the right way. Okay, now look at this example. This example, again, we have an impulsive move. Okay, we have correction over here, and then we take this move to the upside. Now This is why this trade didn't fail. First of all, you are in line with structure. You have that break of structure over here, so it's a bullish break of structure over here. Okay, so BOS up. What do we see? We have two levels of demand that we need to focus on. If you're trading smart money, you understand what I'm saying. Again, we have a candle in here that we need to look at. So the first one, and then the second level over here, but we can see the price reacted off the first level. Okay, if you also understand liquidity, you would know that all these lows over here were relatively equal lows. So that's inducement. So if you're a smart money trader, inducement down. If you're a smart money trader and you didn't understand what was happening, you might have had your entry here and your stop loss below this low. And what do we see is that, especially when your stop loss is very tight, what we see is that price just taps into your stop loss a little bit, like with some just a few pips, and then it moves in your direction massively. Okay, it moves in your direction massively after that. But if you understand that this is liquidity, okay, this relatively equal lows are liquidity, and this is just an FU, an inducement, then you'll be able to capitalize on this trade on lower time frames. Okay, I'm not going to show that over here, but you see that after taking these equal lows out, okay, it just comes in the first time here and then the second time here, and then even give you another opportunity the next day over here to take a buy to the upside. Okay, I am not going into details with regards to this buy. I'm just showing you how, coupled with market structure, understanding demand and supply and liquidity pools in here, this trade played out just with that impulse correction, okay, and break of this corrective move while it moved up. Okay, another example is this one over here. Now this one has to do with you identifying liquidity pools. Okay, so this point over here is the Asian low, and the Asian low is a major liquidity pool. I'm going to do a video on Asian low. I'm going to be explaining the Asian liquidity. Okay, so this low over here is the Asian low. That is why you see price smashing through. Okay, so if you're looking to take the trade on the third touch, first touch, second touch, third touch, what do we see again? Okay, what do we see? A bullish inside bar over here, and then that is your entry confirmation for those who trade the chart patterns. You can see. Then what do we get? It smashes you out and it moves in your direction. Alright? So the reason is because, like I said, the Asian low over here is a major liquidity pool that you need to watch. Okay, this trade, I remember this particular trade, it induced both smart money and retail traders, those who are trading smart money. If you're trading chart patterns, I mean, it took it out because the retail trader who don't understand the Asian liquidity also saw something like a break of structure to the upside. All right, a break of structure to the upside, saw a level of demand over here which he is supposed to take. Right, so the smart money trader was saying that, okay, after this break of structure, price comes into a level of demand. What do we see? We have a confirmation to take the buys. Okay, so that would have been the confirmation of the smart money trader. And then what happens is that it takes that smart money trader out and then it moves in your direction, just because you didn't understand that major liquidity pool over here, which is the Asian liquidity. Okay, so you can see, if you are putting all these things together, you're going to be getting the right trades. Okay, now in this scenario over here, we can see that first of all, you were with trend. Okay, price is making lower highs and lower lows. You were with trend. Okay, so that is what I'm saying. If you understand market structure, you understand major liquidity pools, and then you are just adding these chart patterns, you are still going to make some pretty decent win rates, some pretty decent profits just in this case. So what do we see over here? We see a demand zone over here. Even though price didn't tap into that perfectly, we can see again a break of structure to the downside. Okay, a break of structure to the downside, and what do we see? We see price making what? These corrective pattern. So if I'm adding all these things together, break of structure, demand, sorry, a supply zone over here, and then price coming back into the supply with a corrective pattern. I mean, yeah, your first touch, your second touch, your third touch, I mean, it's gold for you. You can take that. Okay, even in here, we can see again price. Again, you are in a direction of price. Market is making lower highs and lower lows. Okay, so if you are looking at this trade, you can see we have that corrective pattern over here. Where did it come to? Into that supply zone. We have our first touch, our second touch, our third touch in here, where within supply zone. Okay, I mean, you can just take that sells to the downside. Okay, so you can see that these strategies work, but then you need to have the right knowledge, okay, to make a decent profit from all these strategies. Again, what do we see? Price making lower highs, lower lows, lower highs, lower lows. So first things first, break of structure. We have identified our protected liquidity. Watch the first video in my liquidity series. Protected liquidity. What do we have again? An ascending channel. Okay, what do we see? Our first touch, our second touch, our third touch into where? The protected liquidity zone. So if you are taking that sales from here, praise the Lord, you are good to go. Again, what do we see? Internal liquidity has been taken. This point over here is an internal liquidity. It has been taken, okay, into that supply zone. So if you're taking your sales here, you are good to go. You can see. All right, so this will be the last example, then I will bring this video to an end. Okay, and this has to do with an advanced liquidity concept, taking into consideration the mid-Asian range, okay, the equilibrium of the Asian range. Okay, so we can see that we had this IFC over here, which price didn't come into. Okay, but what we can see is that we had another level of imbalance, and that's where price came to. So price came in to fill that void in the market, this level of imbalance in here. Okay, that's where price came into. Okay, so before this inducement, what was price do? Okay, this it presented us with a common retail pattern. Okay, so those who were looking forward to sell here on the third touch, what did we see happen? It took them out on a loss. Okay, so you might have entered on the third touch with your stop loss above structure over here, and then what do we see? We see price hitting that stop loss, and then those who were also buying on the third touch from here, okay, it also took them out on the stop loss, and that is inducement. Okay, but the beautiful thing about this is that if you understand what price is doing here, combining this with the Asian session liquidity, you realize that after price inducing both sellers here and buyers here, it gave us what? An entry confirmation on lower time frames to sell. Okay, so you can backtest that on the lower time frames and find out how we got that confirmation for those sales. Okay, so guys, this is where I'm going to end today's video on the trend line liquidity. The next video is going to be on the Asian session. I'm going to talk about the daily forex daily cycle. So if you really like this video, kindly give this video a thumbs up, kindly share this video, and leave your comments in the comments section. So see you in the next video.